Hello, fellow Rebel Capitalists. Hope you're well. I'm here with my good buddy and commodities expert, Rick Rule. He really needs no introduction. You guys all know who he is. And he's just setting up something called Battle Bank that we're going to talk about in just a moment. But before we get into it, Rick, thanks for coming back on the show, but it's always awesome to talk to you.
It's always my pleasure, George. I'm grateful and frankly thankful for being allowed to be back. Thank you.
Now, we were just talking about a spot that most people probably have never heard of, but oddly enough, it's a spot that you and I have frequented quite often. Now, I've been frequenting it over the last couple of months, but you have gone there over the last, 30 years?
Yeah, amazingly, I got out alive early on.
Yeah.
That isn't a challenge any longer, I guess. But
No, but the place that we're talking about, guys, is Marato, Colombia. And now what's interesting about Marato is it's this mountain where they've been mining gold for the last 400 years, and they're still doing it today. And when I'm talking about mining gold, most of you probably think of some big corporation that's publicly traded on the Toronto Stock Exchange and this big outfit. When there's that, but up on the hill, up on the mountain, it's all these mom and pop mines that are literally nothing but a hole, and not that big of a hole, in the side of the mountain where they just go up there with their donkey. They climb in there, they grab some rocks, they put them in the bucket. The donkey takes it across the street and they grind it down. So when Rick first went there, it was a little bit of a dangerous place, wasn't it, Rick? Tell him about the helicopter flight.
yeah, when I was first there, it was because there was so much money being generated there, and because so many people wanted access to that money. The narcotraficantes were there,
Yeah.
the left-wing guerrillas were there, and the right-wing contras were there. And they were all largely unsavory characters. So I went in with a really crazy Mexican guy, Raul Madrid, fantastic geologist. And he told me that the Colombian narcotics guys were afraid of Mexicans. So he would act as crazy as he possibly could so that the narcotraficantes would think that he was a Mexicano narcotraficante. And he said, "We've got an hour and a half here. We're coming in by helicopter. We're going to go light. We're going to go fast, and then we're going to get you out of here."
Yeah.
So I remember being a bit apprehensive about that. Nothing happened, but it was amusing to me to be easily the only gringo within 10 kilometers.
What year was that, Rick?
Oh
Roughly?
God, it was in the early 90s.
Oh my
It
gosh.
was it was at a point in
that
time where even where you are in Medellin, it was not a healthy, comfortable place.
No, that was sketchy back then for sure.
Marato was what geologists would call a triple plate junction, except for not in geological terms. As I say, it was the narcotraficantes, the comunistas, and the contras, all competing to tax the garimparos, which is the colloquial name in Spanish for the informal miners.
Wow. So now if we fast forward to last month I just went there last week, but I've been there a couple times. And I'll bet you it looks almost the exact same, except for that town that they had just on the side of the cliff.
Right.
Now lower down the road, they've got a new town with, some bars and restaurants and cafes. It looks pretty cool, but it's still very similar up on the side of the cliff. And, I've been there a few times and I kind of got to wondering, Rick, I didn't see any police officers or any security guards. And this last time that I was there, I was thinking, there's a lot of gold because there's maybe like 100 of these, or maybe 50, 100 of these small mom and pop mines that are bringing out a decent amount of gold every day. I mean, it's got to be millions of dollars worth of gold every single day. And so I go down to the local shopkeep there and I asked the gal, I said, she hadn't seen a gringo in probably since you were there.
Right.
And I said, how come you guys are doing so much gold every single day? How come there's no security guards or police officers or anything? She goes, "Oh, that's easy. It's actually very safe here now because if anyone gets caught stealing anything, I mean, a paper clip," she goes, "they take them out back and they instantly shoot them.
Right.
They kill them."
Our mutual
that's how
friend
we keep it so safe here.
our mutual friend Doug Casey once observed, talking about Colombia, that a heavily armed society is invariably very polite.
Yeah. Yeah, yeah, that's right.
The problem,
Marmato is a living proof.
the problem in Marmato is that 30 years ago, you had three competing governments,
Mm,
all informal, and they were fighting each other, and they were seeking to exert control where the three of them came together. uh, Marmato now, it would seem like there's a fairly efficient form of local policing, which often happens
yeah,
in informal boom towns, around a modicum of government control, with the narcotraficantes having moved from Antioquia down to Putumayo, as an example, and the left wing guerrillas and the right wing guerrillas having much less reason to go at each other.
yeah, yeah. That makes a lot of sense. And boy, it's just interesting how that plays out in like a, I don't want to say a free market, but an area that doesn't have the policing, where they're just basically they're making up their own rules from the ground up, but they really make it work, you know.
You know,
Anyway.
George, what you say, I've examined in several different parts of the world. There was a boomtown, the name of which escapes me, in Mindanao in the Philippines,
Hmm.
which had 200,000 people, and the same informal gold operation, and it had the same form of policing. If somebody got out of line, the best that could happen to them would be that they were shot.
Yeah.
That's the best.
Right. Right.
A different point in time, I was in the gold souk in Dubai, which is acres of shops with physical gold. I mean, so much gold that there's a yellow hue to everything. And I asked one of the shopkeepers, I said, how does security here work? And he said, nobody in their right mind would try to take down a shop here. You know, there's
Yeah.
600 of us. And he said the security network affected by 600 people with interest in security, very high, very
Yeah.
high.
So, so on that note, my friend, what's going on with gold? What's going on with uranium? I mean, oil price,
Yeah.
that's really interesting to me because I think we're close to 80. And a lot of people think that's inflationary, but I don't know about that. You know, it all depends on the money supply. So let's just start with your overall view on commodities. What do you find most interesting right now?
You know, let's talk with oil. The last time we talked, I don't know if you remember that, but I replayed that interview in preparation for this one, make sure I
Okay.
didn't say anything profoundly stupid, which mercifully I didn't. Uh, but I talked about the strength in energy prices, and I talked about the fact that the energy prices would wax and wane, but that the oil stocks would do well because the
Mm,
oil stocks were priced as though peak oil demand was going to occur in 2030 or 2032. Clearly, that didn't happen. Now, if uh, we have a political accommodation in the Middle East and a real ceasefire, if the risk around Iran shutting down the Straits of Hormuz passes, and particularly if that happens in conjunction with some settlement of the Russian Ukraine conflict, I could see the political premium around oil declining.
right.
What I can't see is any limit to the utility of oil and gas. And in particular, I think we're within a couple of years of the end of the gas bubble. We've overproduced natural gas in North America for a very long time because we're producing it as a byproduct of oil. And for a while, there was such a plethora of supply relative to our ability to use it or transport it or sell it that gas prices occasionally went to zero or even below zero. But we spent billions of dollars every month addressing that.
Right.
The reshoring, as an example, of European manufacturers that use natural gas from Germany, where they can't get gas, to the United States, the building of transmission infrastructure, processing infrastructure. So the increase in the price of natural gas that we've seen, which is much more dramatic than the increase in the oil price that we've seen, I think is a harbinger of things to come.
Hmm.
At $80 a barrel, we don't need higher oil prices to justify the process of drilling wells, producing oil, and stuff like that. At a dollar gas, we did need higher gas prices, and now we've got higher gas prices.
Because that was under the cost of getting it out of the ground.
Yeah, I mean, there was an insane arbitrage that existed a year ago. Gas was selling at Henry Hub for $1 a thousand,
Hmm.
or put differently, a dollar per million BTU. And that same million BTUs was selling in Shanghai or Tokyo or Rotterdam for $9. And it
Hmm.
took $2.50 or $3 to get there. So basically, $4 material was selling for $8 or $9.
Wow.
Uh, that was too big a gap. And billions of dollars was spent arbing that gap. And we've said on your show before, the cure for low prices is always low prices. And we're beginning to see that in both oil and gas. We haven't seen it in the equities prices yet. We haven't seen the equities prices of oil and gas companies reflect the fact that the oil and gas business isn't going out of business in 5 years or 7 years.
Hmm.
Biden and Trudeau and that noted energy physicist, Greta Thunberg, would have you believe that, post 2032, that poor people in Malawi are going to be driving Teslas or something like that. And, they never answered the question, George, and I'd be interested in your view on this. These big thinkers, how they would get their 1,000 jets to Davos or Doha to tell you and I to drive less, were it not for oil and gas derived jet fuel. But at any rate,
They're going to burn
uh,
lumber, Rick.
that's what. Yeah,
Cow dung.
sawdust.
The
Yeah.
new G5 it's powered on
Yeah.
cow dung.
Why didn't I think of that? Why didn't I think of that? The point of this for your listeners is that people who are income oriented in particular need to pay more attention in the oil and gas business. It's not going out of business. It's priced as though any net present value by way of tail after 7 years won't exist because the market won't exist. And the market's going to exist. I suspect peak oil demand, depending on price, occurs in 2065 or 2070. It is cheap, cheap, cheap.
Mhm. So, assuming that we have that demand, what's your supply side case there? So
That's a
demand
function of
is
price. It's a function of price. The most over-drilled piece of real estate on the face of the earth was the U.S. And a conjunction of technologies, horizontal drilling, measurement by drilling, uh, three-dimensional seismic, and fracturing,
correct.
combined with a reasonably permissive regulatory environment and a very low cost of capital, meant that we took the most over-drilled piece of real estate on the face of the earth, and we've almost tripled production from it.
Right.
The same geology occurs in Germany. It occurs lots and lots and lots of places. In particular, it occurs in the Persian Gulf. So the idea that we can't increase production if the cost of capital stays low, if the technology stays the same or improves, and if the oil price stays high, but particularly if politics allows us to, uh, there's a lot of oil to produce with this cost of capital and with this conjunction of technology. Probably from an investment point of view, the most attractive is in Argentina if the politics stay the same.
Hmm.
The Vaca Muerta shale in the Neuquén Basin in Argentina is arguably as permissive as the shales underneath the Permian in West Texas. It's just that Argentine politics and the fiscal regime in Argentina has been such that the industry didn't have the courage to go in there and exploit those shales. But the future for the industry is extremely bright, particularly as various parts of the world come to understand that uh, oil and gas is reliable and cheap energy.
Yeah, and also is the step ladder for the poor to get up to the middle class in all of these emerging markets. I mean, that's what everyone forgets.
You know, George, that's so important, not
Yeah.
just for investment reasons, but there's a billion people on Earth that have no access to primary electricity. None. They want to live like you and I. And I'm interested by what Wright, the big thinkers, suggest that all of the cost associated with the energy transformation should be borne by poor people. Uh,
Yeah.
I I personally believe that's unconscionable. I also believe that the poor people are going to have their way. Uh, you know, uh, one of the unheralded advancements of our species is that in the last 40 years, we've done a spectacular job lifting the poorest of the poor and making them merely poor, as opposed to extraordinarily poor. And I suspect that we will have addressed extraordinary poverty on this planet in 20 years, which is a wonderful thing. But addressing it will increase demand for a lot of resources, because when extremely poor people get more money, it's material goods that improve their standard of living. When George Gammon gets more money, he buys a service or he buys some little gizmo from Apple that's all ideas and no stuff. But when a poor person gets more money, they increase the calorie count of their family. They
Right.
maybe replace a thatch roof with a steel roof. And importantly, they go from barefoot to sneakers to a bicycle to a 50cc motorcycle to a Toyota Hilux. They do not go straight to a Tesla. That's not what happens.
Yeah, and I see that just play out every single day in
In
Med, even
Colombia,
with
you
my
see
own
it like crazy.
employees, Rick, even with my own employees, I've seen them just kind of go up the food chain, so to speak, there in the form of transportation, just like you said.
Well, congratulations, George, for helping them. You're a force for good.
Yeah. So what I'm hearing you say from an investment standpoint, or what's going through my mind, is assuming we don't hit peak oil for whatever, or peak oil demand, excuse me,
Peak oil demand, right?
until 2060 or something, we should continue to see this cycle of oil just mean reverting, because
That's right.
that's just what it always does. Like you
Right.
said, the cure for
Yep.
high prices, same thing. But
Yep.
does that, so when I first started doing videos, I know that inflation adjusted, the kind of mean, or right in the middle of the kind of price structure for oil, uh, oil would get expensive over 80, and it would get cheap under 30, inflation adjusted. So now that we've had inflation, what that means, or substantial inflation, is what that means is now the lower end of the scale there is about $40 a barrel. So
I think it's
how do you, like the frackers, if their cost to produce is a lot higher, and that's a lot of the, or a higher percentage of the additional supply, does that mean that middle price point is going to go from, let's just say 55, maybe up to 80 in the future? You see what I'm saying?
a guarded yes.
Okay.
There are probably 5 variables. One variable is geology. It is arguable in Texas in particular, less so in the Marcellus on the U.S. East Coast, that we are fairly rapidly drilling through our Class A locations.
Right.
So our ability to use current technology to continue to increase the pace of U.S. production is beginning to be challenged. A second challenge is that we're producing so much byproduct salt water that we're having a difficult time finding a place to put the water.
Hmm.
There's some danger of incursion into fresh water. There's also seismic events that are happening as a consequence of putting more water into horizons than has traditionally been there. So that's a challenge. A third challenge is the cost of capital. Uh, the cost of equity capital in the oil business is fairly high. If you look at the price of the stock relative to the price earnings multiples in other industries, but the cost of debt is fairly low. So partly in a capital intensive business, the cost of capital. Uh, then there's 2 more variables. One is regulation. There was a de facto opposition to oil with the last administration in Washington. Biden, on the one hand, said it was evil stuff, and on the other hand, for political purposes, he wanted to keep gasoline prices low. So he was a bit challenged. I think Trump is under less challenges. I suspect that the regulatory regime for the next 4 years, although perhaps de jure regulation, which is to say legislation won't change much, I think that the informal blockage, the informal power blockage around the energy business will subside substantially in the next 4 years. And the fifth variable, of course, is technology. What we've seen in the last 15 years is a conjunction of technologies that were developed 20 years ago. To the extent that we develop technologies that do a better job sweeping oil and gas out of tight horizons, or improvements in drilling technology, um, or improvements in targeting technology, it might be that some locations which are currently grade B locations become grade A locations as a
Right.
consequence of our ability to drill them and produce them more cheaply. So there's a lot of variables. It isn't merely the variable of input cost times inflation.
Although it seems like if it gets too far to the extreme in the
It
short
collapse.
term, then there's a
Certainly.
high probability that, like as an example, if it gets below, let's just say we have a recession and it gets below 30, that in the next 6 months or a year, there's a high probability that it trades above that 30, or if it trades at 120 or 130, then there's a high probability over the next 6 months it comes down to, let's just say, 100.
And I think you can draw the bands a little tighter than that now.
Yeah.
The International Energy Agency in 2021 said the median cost to produce a barrel of oil, fully loaded worldwide, was $60 a barrel. Now, that includes cost of capital and it includes social costs, which is to say taxes and royalties. The industry can produce below their cost of production for a fairly substantial period of time, like 2 years, 2.5 years, because it's a capital intensive business and they've already sunk the capital.
Right.
But prices below $60 a barrel uh, keep the industry from maintaining, sustaining capital investments. And after 2 years or 2.5 years, the production side of the equation corrects very, very, very aggressively.
Hmm.
Similarly, when the industry makes too much money, I use that phrase guardedly because I'm in the industry and I don't mind making too much money personally. But at any rate, when from an economist's point of view, the industry is making too much money and their access to capital is too cheap, when capital floods the business, in fact, overproduction occurs. The other thing that happens is that markets work a different way. The politicians don't believe this is the case, but Americans are rational. When the price of gasoline gets too high, people drive less.
Right. Decreases
It's
demand.
weird how that works. People actually act in their own self interest. It would be useful to you to know, and for your listeners to hear, I think, that same International Energy Agency, by the way, no friend of the oil business, that's been captured by the butterfly and salamander crowd. But the International Energy Agency suggests that the oil industry globally, including state owned firms in places like Venezuela and Russia and Mexico, is currently underinvesting in sustaining capital investments to the extent of about $1 billion US a day.
Hmm.
And in North America, even some of the private sector isn't making sustaining capital investments in favor of increasing distribution to shareholders because they're concerned about the legislative environment going forward. So, despite the fact that the oil price in historic terms is in very good shape and the natural gas price is in good shape, the industry has still been underinvesting, even in North America, in sustaining capital investments. In Russia, the reason for that is understandable. They need money to fight a war. They can't do their sustaining capital investments. But the idea that private sector companies in North America have been under investing is a bit more perplexing. They say their challenge has been the net present value of investments today, given the uncertain regulatory future.
Yeah, that makes a lot of sense. I mean, most people think that this is just like a light switch. We just turn on and off real quick, but these people are having to make decisions, certain locations that will impact them for decades into the future. And
Right.
when you have uncertain politics, that's not an easy check to write, especially when it's billions and billions of dollars. What do you think, or have you given much thought about Trump reducing or getting rid of the sanctions on Russia if he can somehow, get that war to end and what that does to supply and the price?
That's bigger than me.
Yeah.
Uh, so I don't spend a lot of time thinking about it. I had the misfortune, I guess, of reading Trump's book, uh, The Art of a Deal, where he talked about the value of bluff and bluster.
Yeah, yeah.
And a lot of what he does today seems to be a product of the techniques that he described in the book,
Yeah.
which is to say, don't let yourself be troubled inordinately by the facts, and don't concern yourself too inordinately with broadcasting facts. Think about what you're trying to do to occur, what you're trying to cause to occur, and think about how you must do that.
Yeah.
Uh, Confusion to the enemy, making opposition to you personally unpleasant. Uh, I don't think it's a great book, but I would encourage anybody listening to this podcast and being interested in what they might expect for the next 4 years to read the book.
Mm. Yeah, it's a great point. Great point. And I hope that's what tariffs are. I mean, I think tariffs are great from a standpoint of negotiation,
Right.
but as far as implementation, I think it's a disaster. So hopefully that's what he's doing with the whole 100% tax on X, Y, and Z and whatever.
Trump, like the moron before him, uh, understood that one of the paths to power is expressing the outrage of certain classes of society. In Trump's case, the nationalists. In Biden's case, I'm not sure who he's speaking to other than not me. But you know, and I know, George, that tariffs are taxes.
Yeah, right.
It would seem that there's some aspect, some group of the voters who don't seem to get that. Terrifyingly, those same people can do jury duty.
Yeah. Yeah, exactly. Well, I'm gonna just keep my fingers crossed. I'm gonna give him the benefit of the doubt
Me
and
too.
just assume that
What's our
he's
second
using
choice?
the
Well, you exercised your second choice. You're in Medellin, safe.
yeah, yeah. But let's give him some credit here, where I think it's fantastic that Trudeau is gone. I mean, I think that's a huge, huge win for freedom, liberty, and free market capitalism, the stuff that we stand up for. And Trump was able to get that done to a certain degree because he talked about the 25% sanction. And all of a
I,
sudden, 2 weeks, 3 weeks later, Trudeau's out. So I don't know that that was the whole
yeah.
reason, but it seems to be the straw that broke the camel's back.
I wouldn't be inclined to give Trump credit for that.
Okay.
I think, frankly, that the specter of Trump, who many Canadians hate, was good for Trudeau. Trudeau didn't have the ability to run on his own record because it was horrific,
Oh,
and he spent 3 months running on not being Trump.
right, right.
However, in the case of Trudeau, his track record caught him.
Mm.
That there's a track record, at least economically, virtually unblemished by success. And at some point in time, his sunny narrative lost out to the reality of Canada's economic performance.
Yeah,
And
so that especially is clear when you start to see the housing market decline there
yeah,
substantially, and you see the unemployment rate go from, was it 4.5%? Now it's almost to 7. That is not a good formula for the politicians.
and had it not have been for a proliferation of newly created government jobs,
Yeah.
it would have been much, much higher. Trudeau, like Governor Gruesome, is a superb campaigner. And, there are elements of the sort of progressive power elite that have a lot of use for somebody whose political nose is good, who women think are fun to look at, and are good campaigners. And I think Trudeau served that function. I would argue that Governor Newsom's economic track record in the state of California and his track record as governor, or pardon me, as mayor of San Francisco is appalling.
Yeah.
But he maintains broad popularity.
What do you
I,
think is
I
going to
think,
happen now with the fires, Rick and
I
Newsom?
mean, I personally wouldn't hang the fires on him, but I'm glad that somebody who is less proud than I is willing to do that.
Yeah, that's my
And
point. Even if it's not his fault, he's going to get the
I
blame
think
and could get the boot.
I think he probably deserves a bit of blame for the fact that he spent money on a lot of things rather than infrastructure and preparedness. I think
Mm.
the response to the fire and our capability to respond to the fire is partly his responsibility and is also the responsibility of municipal leadership that would rather spend money on politically expedient consumption programs, something that generates votes within 90 days, rather than on preparedness, something where the benefit to society is expressed over 10 years or 20 years. Whether or not that's the fault of the individual politician or whether or not that's the fault of society and voters is a different question. But again, that one's bigger than me.
I know you're at the end of the day, you're not really a commodities guy. You're more of a risk analyst. You said that many
That's true, but
times.
I confine my risk analysis to either conventional financial services, businesses I understand, or resource businesses, businesses that I understand. I don't do risk analysis outside areas where I've, come to understand those businesses well.
Yeah. Well, have you ever been involved with an insurance company?
Oh yeah, I have a deep involvement in the insurance
So,
business that I have for
how,
50 years.
how do you think the property and fire insurance works moving forward based on what's happened in California over the last month or so? I've
I
tried to
think
think about that, and
I
I'm
think
like,
the next year and a half is going to be very hard
yeah,
because the legislature in California restricted the ability of the industry to charge sufficient premium to guard them against real risks. The
right,
consequence of that is that the smarter insurers left the state of California. The voters would like to see that as a market failing. In other words, they would like to shift financial responsibility for where they choose to live from themselves to the insurance companies. Of course, I see a need and I'd like you to fill it, please. And I think for the next 18 months, it's going to be politically expedient to beat up the insurers.
mm,
What will happen is that either the state of California will have to go in the insurance business and have the taxpayers shoulder the liability, which leaves less money available for other politically expedient spending programs, or we're going to have sanity in the property and casualty market. I have personally never been attracted to retail property and casualty. I've never invested in health insurers. I've never invested in auto insurers. I've never invested in fire insurers because I've understood that when I provide capital to reduce risk, the customers think I'm a villain.
right,
I provide capital to insurance around things like offshore oil and gas installations. And the voters don't ever believe that offshore oil and gas drillers need to be protected from vultures like me. By the way, a sentiment that I agree with completely. I don't have any interest any longer in apartment buildings for the same reason.
mm,
I don't want to get in the way of voters when they enact rent control, however stupid that might be. If you, George, look at the underwriting results and even the return on equity, or particularly the return on capital employed in retail property and casualty, uh, it has not been a particularly attractive industry.
yeah. So
When
let me reposition the question, looking at it from the standpoint of the consumer. So what you're saying
right,
is it makes absolutely no sense for these insurers to insure these properties moving forward because they can't charge a price
correct,
that makes sense due to the local politics and ironically, protecting the consumer. So if you're one of those people that unfortunately lost their home and it's
yep,
going to cost you, $2 million out of pocket to rebuild, and you know that there's a very low probability that you're able to get insurance moving forward, what do? If you've still got the mortgage payment, but all you have now is just a piece of land? I say I'm trying to figure that out for the local economy
well,
and
first of
and
all,
kind of the individual.
if you decided to go naked on your insurance for the last 3 years because you couldn't afford it, uh, you'll now see the penalty of going naked, which is to say your house will be foreclosed on. You'll be gone.
Yeah,
You're
and
done.
there's no way you rebuild,
If you
even if
rebuild, one thing that people need to understand is that you can lower your own insurance bill markedly by mitigation by building your building and landscaping your property in a way that's fire defensive. I just built a home, when I say just, 4.5 years ago in Northwest Washington. And we live in a flood area. We live in a forest that's subject to forest fires. There are threats here from high wind. And we incorporated disaster mitigation into the construction cost of our home in conjunction with Chubb, our insurer. And yes, the capital cost was higher, but the savings in terms of our property and casualty insurance were really, truly dramatic. And I think there will be a lot of opportunity in the rebuilding of Malibu and Pacific Palisades. And perhaps there will be some guidelines incorporated into permitting and construction standards that will go a long way towards mitigating future risk and moderating future premiums. I have a relative who lives in Studio City that for 50 years, for budgetary reasons, has left a cedar shake roof on their house.
Yeah.
In that part of the world, let's just say that's not best practices. And I hope, because these relatives are ones I like, that they address that. You know, I used to joke that they were going to be guests of honor at their own barbecue if they didn't address that. And I think now, you know, when they look at the responses to the housing in neighborhoods not too far from them, and I hope broadly as a society, that those people who live in fire-prone areas incorporate as much fire preparedness into the construction of their home as is possible. And sadly, now we have what, 15 or 20,000 homes to practice on?
Yeah. But would you have built your house if getting insurance was not an option?
No,
Yeah.
no. I think the insurers, just like I'm a lender, and often my comments to potential borrowers about the downsides of what they're trying to do are helpful to them. I think homeowners are the same. You know, Pacific Palisades, it's nice weather. It doesn't rain much. You have this wonderful view of the Pacific. Fires burn upslope, not downslope.
Yeah.
And people were thinking about what a wonderful lifestyle this is. The schools are good. It's close to the freeway. It has a wonderful view of the Pacific. The weather's great. They didn't. Oh, and by the way, there's a nice canyon with open space and, you know, pretty birds and no houses in front of me. That's all good. Well, some of it's not so good. uh, you know, no rain means that stuff gets fairly dry. Nice breezes when they turn into winds if they're propelling fire. Not so good. That open area in front of you, that chaparral covered canyon, at times like this, that's called fuel, not chaparral, not habitat.
Right.
And this is a wake up call, a sad wake up call, a dramatic wake up call for a lot of folks. The second thing is, of course, down in Malibu and Topanga, places like that, the Coastal Commission got in the way of rebuilding. It's interesting now that both the mayor of Los Angeles and the governor of the state of California say, we have an emergency. We need to cut red tape. Well, we've had an affordability emergency, which they described. We had a rent emergency, which they described. We had a homelessness emergency, which they described. Those were all emergencies. Why didn't we cut, quote, useless red tape 20 years ago?
Right.
Had we cut useless red tape, perhaps we would have addressed those other three emergencies while addressing this emergency too. I'm not trying to say that doing it now isn't a good thing. I'm saying that the voters need to ask themselves how this red tape suddenly became useful, and why it wasn't addressed 20 years ago by the same people who instituted it.
Yeah. I'm hoping maybe this will be an epiphany moment for a lot of the voters there, that they say, wait a minute here, I thought big government was great, but now that I have to deal with big government and getting a permit to rebuild my house that just burnt down, now all of a sudden I don't like it. I need to rethink my political views.
I hope so too, George. I hope so too.
Rick, what do you think about AI and the energy use? Let's kind of shift the conversation, back to maybe nat gas and then over to uranium. Because if AI is the future, which we'll have to see, it most likely is. It's just nothing goes in a straight line, kind of like the internet. But it's going to require way, way, way more energy than we currently have available. So how do you see that playing out, affecting demand and kind of the current grid that we have, and therefore maybe some opportunities with the infrastructure plays and commodities in general?
I'm an energy investor, George, and you can see my smug smile.
Yeah.
AI isn't the story, but it's a story.
Yeah.
The truth is that a bigger story probably is 1 billion people on Earth with no access to primary electricity,
Hmm.
and 2 billion people on Earth with only access to intermittent or unaffordable electricity. Because you and I aren't part of that club, we think about increased energy demand in a way that impacts us, which is AI.
Right.
But for people in rural Colombia, having access to electricity at all is an important thing. So let me get this straight, or let me make this straight. I'm not opposed to alternative energies. I've invested in wind, I've invested in solar, I've invested in all that stuff. As you've learned, or as they have learned now in California, there are times when the wind doesn't blow and the sun doesn't shine. Night, as an example, is pretty challenging for solar energy. And for that, you need intermittent peaking power. You need natural gas. Without natural gas, wind and solar does not work. The big thinkers' wishes notwithstanding. We've learned too, we need nuclear. Uh, and AI is an important part of that. The important part for me of AI is that the intermediaries, the people who will use the energy to build the data centers to utilize AI, also want that energy to be, first of all, 24/7, not intermittent.
Right.
They want high quality deliverable power and they want it 24/7. And they want it to generate no carbon.
And they
Now,
want
for
cheap.
them, they want nuclear.
Right.
The idea that 3 Mile Island, uh, the facility responsible for the demise of the US nuclear power, is going to be restarted with a data center in it
Hmm.
speaks volumes. I mean, speaks absolute volumes. Where AI really matters, because AI is going to be sited in places that are very rich and can afford it, is going to be in nuclear power. Nuclear power is the killer app, generates reliable, low cost, non intermittent, non carbon generating energy. But that isn't the whole energy story. When people talk about carbon, including in your new homeland, Colombia, uh, when they attend conferences like the Kyoto Protocol Conference, and they talk about carbon generation in the United States and Germany and England and places like that, we try to set not national quotas for carbon generation. But in emerging and frontier markets, they say, whoa, 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 not national quotas, per capita quotas. And by the way, we generate 20% as much as you all do. Our
So it's people,
utilization
new
is growing
people.
faster. Yeah, but we need to consider it per capita. That's what China and India are saying. And you know what? They're right. They're not wrong. They're right. The second thing they say is that if total carbon loadings are the problem, then you have to look at historic carbon generation. And historic carbon generation has all occurred in the West.
Hmm.
So we have to get a credit for the current problem that we didn't cause to occur. What that means is that if the carbon goals for 2050 are going to be met, all of the costs are going to be borne by rich people in developed countries. If you want a template for how that works, look at Germany.
Right.
Look at a place where power became less available and where the price rose fivefold. Now, try to imagine a Biden or a Trump or a Trudeau or a Merkel who says, for the good of the world, your energy is going to become intermittent and we're going to raise your power bill by 500%.
Yeah. In other words,
In
we're
other
going to
words,
decrease your standard of living by
yeah, try to tell
50%.
try to tell voters the truth.
Right.
What we're saying is that we're going to save the world, we're going to save the salamanders, and most of the cost is going to be borne by India and China, who haven't enjoyed the benefit. I don't reckon. What, whether or not this is good or bad isn't something I'm arguing, George. What I'm arguing is if the Kyoto protocols are going to be observed, all of the cost is going to be incurred in the West, who generated all of the problem.
Right. So I think what I'm hearing you say, as far as the AI stuff, that's very bullish uranium. But
Hugely
outside of
bullish.
that, the bigger demand story is with the people going from the bicycle to the 50cc motorcycle to the Hilux. And
Correct.
that's more about oil.
Yep.
And then where does nat gas play into that equation?
We're going to need more of everything.
Right.
If you look at conservative estimates of the increasing utilization of various forms of power, including transportation fuels, the growth in population and the growth in wealth in the existing population means that energy demand is growing really, truly, amazingly. If you look back to the commodities and energy market that existed in the period 2000 to 2010, that was mostly a function of an underinvestment in productive capacity for 20 years. But on the demand side, it was a function of the urbanization of China. It was a function of Deng Xiaoping saying to be rich is glorious. And they did a wonderful job. They moved into urbanized, lower middle class existence, 500 million people.
Mm.
Now, worldwide, we got 2.5 billion to go.
Right.
And maybe the rest of the world won't be as efficient as the Chinese have been in terms of doing that. But think of 5 Chinas, and then you think something about the size of the challenge around a whole bunch of industrial materials, including, of course, energy.
Yeah. Where do you think we are on in the cycle of uranium itself? Because, we were talking about oil, the cure for high prices, the cure for low prices, low prices. And I haven't looked at the spot price of uranium lately, but I think it's down substantially, maybe over the last 6 months or so. So when do we get to the point in uranium where it's under the cost of production and we should start looking at it through that lens?
I'll answer the question, and then I'll explain why a different variable is more important.
Okay.
Today's uranium price, if you give us time to bring new supplies online, is probably sufficient. Uh, Ironically, by the time we bring those new supplies online, it won't be efficient. It won't be sufficient because input and construction cost increases, the inflation in those is rising fairly rapidly. But a $75 spot price today incents new production, all other things being equal. What's changing really dramatically, though, is that the spot price is becoming less important. The volumes that transact in the spot market are increasingly scarce. In fact, my former product, the Sprott Physical Uranium Trust, on most days generates a higher dollar volume than the spot price, which is to say the spot price is becoming more important than the spot price. What's Yes, I'm bragging. What's important to recognize, though, is that the structure of the uranium market is changing. A term market is evolving. A term market is a contractual market between a buyer and a seller that locks in prices and volumes within a range for as much as 30 years. That means that new project development isn't subject to the tyranny of the term market, that a lender will know 15 years from now how much uranium a producer can sell and for what price. That lowers the cost of debt capital because it lowers the lender's risk. Similarly, a lazy securities analyst, let's say Rick Rule, can generate a cash flow model on a uranium producer and not have to worry about that old variable price, because the price isn't determined in the overnight market, but rather is determined in negotiation, in contract between buyers and sellers. This occurs in no other commodity that I'm familiar with. And what this means in the third instance is that if you are a uranium developer with no existing producing assets and without an investment grade balance sheet, your choices in the old days were to complete a bankable feasibility study and then sell yourself to a major, because you couldn't finance the project. You just couldn't do it. You couldn't do it on a balance sheet. So you had to sell the project to somebody who had a credit grade balance sheet. In today's market, that nascent producer, be they, the Paladins, the Next Gens, the Lotuses, the bosses of the world, can go to Westinghouse, now part of Cameco, get a fixed price contract to build the mine, and then get construction offtake with investment quality offtakers. Southern Company, Duke Power, Tokyo Electric Power, China General Nuclear, and literally take those contracts to the bank. Now, that doesn't mean that the small company won't choose themselves to be a big company, to sell themselves to a big company, but it makes it a much more honest auction, because they can say to the big company, if you don't pay me a fair price, I'm going to build it myself. This is really, really, really changed. Right now, the terms of these contracts are opaque. They aren't being reported well enough that the importance of them has been worked into the market. But markets always work. Over the next 5 years, companies that are forthcoming with regards to their contract terms will have higher share prices and a lower cost of debt, which means that over the next 5 years, the very structure of the uranium industry is going to change, and it's going to change for the better.
So the opportunity is maybe not in uranium right now, but even more so in picking the right companies.
Absolutely. Always has been. It's
Right.
just in this industry, it's easier to do it now than it ever was before, because you don't have to worry about the tyranny of the spot market.
So where do you even start? If you're like a retail investor and you're bullish on uranium for the reasons that we talked about, where do you start trying to pick apart the balance sheet of XYZ uranium company to determine who has the edge?
I think you begin by comparing, depending on the stage of development that the company is in, the preliminary economic assessment, which gives you valuations within a very broad 50% variable, then a pre-feasibility study, then a bankable feasibility study. In other words, you try to figure out what projects are worth at today's spot price. You build yourself a model, or you buy a model from somebody who's built it, that talks about the net present value of that project at higher uranium prices. And then you attempt to decipher, either because the company tells you, or in the case of producing companies like Cameco, because you can work backwards against pounds produced relative to revenue received, what the contracts look like, and you construct a net present value model. A net present value model is never going to be perfect. They never are. It's just that they're more competitive than the lack of one would be. Remember, you're never going to get it right. You're just supposed to get it more right than your competition does. You need to understand that the uranium business and the uranium speculator is rife with narratives. There's probably 100 companies that purport to be in the uranium business worldwide, and most of them are floating abstractions. They're just stories.
Right.
There's 10 or 12 projects out there in the world that have value. And divorcing yourself from narrative in favor of actually doing the work on the preliminary economic assessment, the pre-feasibility study, and the bankable feasibility study is what separates the winners from the losers in uranium speculation.
Yeah.
Most uranium speculators say, well, I read somewhere where the price of uranium can be $500 a pound. I mean, I guess if you give me the use of the word could be, I can tell you any kind of lie you want to hear. But when you understand that most people would rather feel than think, you understand how easy it is to outperform in the longer term most speculators who don't do the work.
Yeah, right. Rick, what do you think about copper? And then I want to kind of parlay that into gold.
I'm bullish on all industrial materials for the reasons that we've talked about. They're demographic. I understand there's been a very long time since we had a synchronized global recession,
Right.
and that in the near term is what could go wrong. We are going to have production declines in copper. It's too late not to have them. Um, if you look at me, George, I'm sort of an icon for global copper mines. I'm old, fat, bald, over 70, well past my prime. Most of the copper mines in the world that supply our copper, like Bingham Canyon's 160 years old.
Yeah.
Chuquicamata is 110 years old. Teniente is 80 years old. The newcomers, Escondida, 40 years old. Grasberg, 50 years old. It's not like you stand on the lip of the mine and throw in fertilizer and water and they grow more copper. And we haven't invested enough money in the last 25 years to stem that. Meanwhile, the permitting challenges have gotten worse. I'll give you an illustration. There's a wonderful copper deposit in Arizona, a good place. 2 towns beside it full of copper miners. Power, water, roads, railroads, smelters, everything you could want. This deposit's well over 1 billion tons, so it's a supergiant copper deposit, and it's 1.5% copper, 3 times the average mine grade worldwide. This deposit has been stuck in permitting for 26 years. 26 years. So,
Like the
what
California Coastal Commission.
Yeah, what incentive is there for me to go looking for a new copper mine in Nevada, or pardon me, in Arizona? I'm 71 years old. By the time I put this in production, my heir successors and the signs are going to be dead. Never mind me. And so we need to work through this. If you have an existing long-lived copper mine that's in the lowest cost quartile worldwide, you're in really good condition. Yes, you could have a couple of bad years, 3 years from now, 4 years from now, 5 years from now if we have a recession. What I've learned in my life is that you have to weather these storms because you can't forecast them.
Right. So on that note, what do you think of gold right now, Rick? And I think the treasuries and interest rates. And then I want to talk about your bank, because what makes your bank unique, if people haven't heard, is you're actually allowing the depositor to keep gold with you guys on storage, and then you're actually lending against the gold, which is really an incredible concept. So let's start with where you think gold is, longer term, short term fundamentals there, and then the bank.
It's interesting, George. A lot of people say to me, well, Rick, you've been around the gold business for a long time. When's the gold price going to move? I said, I think the year 2000 is when it's going to move. It was $253 then. It's $2,700 now.
Yeah.
The gold price is up sevenfold? It's grown at 8.5% compounded for 25 years. And folks say, when is it going to move? That's a really interesting question to me.
Yeah.
But I think it's going to move further, faster going forward. Here's why I think that. The aggregate debt of the United States, on balance sheet, off balance sheet, not my numbers, the government's numbers, $130 trillion. 36 trillion to the bondholders on balance sheet, $100 trillion off balance sheet, mostly entitlements to old folks like me. So we got 2 choices. We could say to the bondholders, too bad, so sad, no money, strong letter to follow. End Medicaid, Medicare, Social Security, military pensions, federal government pensions. Or we could do something else. I don't think Dore is going to occur. At the same time, well, let me tell you how I think we're going to deal with this. We are going to do what we did in the 1970s. We are going to degrade the purchasing power of the US dollar. And we are going to reduce the net present value of our obligation by honoring the nominal obligation, but by making that nominal allocation buy less. In the decade of the 1970s, according to the US government, the Office of Management and Budget particularly, the purchasing power of the United States dollar fell by over 75% in 10 years. Not coincidentally, the gold price went from $35 to $850. It is the interplay between nominal interest rates and the rate of inflation that's the primary driver to gold. So let's look at that. The CPI stated rate of inflation is pretty modest, 2.6. But the CPI doesn't include, when it's inconvenient, things like fruit or fuel. George, if you look at me, any index that doesn't include lunch is out the window, right? I mean, I don't care about it. It's also hedonistically adjusted, which means that rather than use inflation for the price you pay for your computer or your house, they decide what it's worth. In other words, they manipulate the index. Finally, the CPI doesn't include tax. The cost of government is the largest household expense for most Americans. When I look at the basket of goods and services that I buy, and I'm a cranky old guy, I don't buy much. But when I look at the basket of goods and services I buy in the period, let's say 2020 to 2025, what's happened to the price of gasoline? What's happened to rents? What's happened to mortgage? What's happened to healthcare? What's happened to house insurance? What's happened to groceries? These are all political issues because the price has gone up too much. This 2.6 number is insane. It's totally disconnected to reality. When I read shadow stats, the way John Williams looks at these inflation statistics relative to the way that they were calculated in the 1970s, he says that inflation is rising at 12% a year. I'm not that aggressive. When I look at the deterioration of my purchasing power in US dollar terms, I see that happening at about 7.5% compounded. So if you look then at the yield of the US 10-year Treasury, 4.5%, if you look at the 10-year Treasury and you assume that the purchasing power of your principal and interest is declining at 2.6%, you feel okay. You know, you're getting almost 200 basis point real yield. If you look at it the way I do, you're getting 450 basis points in a currency where the purchasing power is declining by 750 basis points, which means that over 10 years, you lose 3% of your purchasing power a year, every year for 3 years, which is 10 years, pardon me, which means that if you loan the government your money for 10 years, they make you 35% poorer. Looked against that, that is to say, real yields net of inflation, brings us right back to the decade of the 1970s. Until the end of the decade of the 1970s, when Volcker took the lid off interest rates, we had a circumstance where the yield on savings products was substantially less than the depreciation of the purchasing power of the currency. And the consequence of that is that gold did well. Unfortunately, George, I believe past is prologue. I don't see any way out of $130 trillion in government obligations. By the way, that number grows. If you combine off-balance sheet and on-balance sheet obligations, that number is estimated by our government to grow at $5 trillion a year. That $5 trillion number exceeds gross government revenues last year before they spent any money. Now, the big thinkers, you know, Bernie Sanders, AOC, these people, I said, no problem, tax the billionaires. Okay. Remember that the deficit grows by $5 trillion a year, and inconveniently for the big thinkers, the aggregate net worth of America's billionaires, according to the IRS, is $5.6 trillion. Never mind raise their tax. If you stole all their money, it negates the deficit for 1 year. A scarier number, George, in supply. And I'm not trying to scare your listeners yet, but I am trying to get them to think about the arithmetics behind gold. If the government is right and our net liabilities exceed 130 trillion, it's interesting to know that the Internal Revenue Service estimate of the private net worth of all Americans is $141 trillion. In other words, we're worth $141 trillion. And at the federal level, before state, local, corporate, and individual debt, we owe $130 trillion. Are we going to have an honest default, or are we going to have a dishonest default? If past is prologue, we're going to have a dishonest default, And that would be very, very, very good for gold.
Yeah.
I would love to be wrong, by the way, George.
Well, assuming the government can create it. And that's a big unknown. You just ask Japan.
Right.
But even in that circumstance, I think that gold does
Japan
well.
benefited from incredible private savings. Remember that Japan didn't come into the lost decade or the two lost decades in a period where government debt exceeded substantially the private net worth of Japanese citizens. They saved, they invested. Now, I think that party's coming to a screeching halt too. But we aren't entering into this from a period of overwhelming personal solvency.
Mm-hmm.
Our math is already lousy.
Yeah. I don't think the Fed is going to have to monetize that unless they want to for psychological reasons. But I do think that a lot of that demand for treasuries is going to have to come from offshore, in which case those are dollars that are created outside of the United States that would come back into the domestic economy and circulate chasing goods and services, which would lead to the exact same or a very similar outcome.
Well, they're going to have to generate a positive yield if they do that. Imagine yourself as the central bank of China.
Yeah.
And imagine the arithmetic around getting paid 4.5% by your sworn enemy in a currency where the purchasing power was declining at 7.5%.
Right, but that's against U.S. goods and services.
What kind of math is that?
Well, it's good math if the dollar's going up relative to the yuan, because that's what they're concerned with, is not necessarily the purchasing power in the United States, but more so the purchasing power in China. Or if you're a bank, you're worried about the spread. You're not worried about
and if you're a Chinese
irony.
bank, you need to decide whether an investment in American goods and services or whether an indirect investment in American productive capacity is better than an investment in Chinese productive capacity. Looking
Right
at
now, it sure is.
looking at that, well, I don't see that.
Well, China right now is into the GFC. I mean, they're really, really struggling over there.
And one could argue, based on the balance sheet of the Chinese government and the balance sheet of the U.S. government, that despite their challenges, we have our own.
He's still on camera.
Do you need to get going, Rick?
I do. I actually have another call I have to take 10 minutes ago.
Oh, shoot. I'm sorry about that. I didn't realize we just had an hour. I could talk to you for all day long. So where can we find out more about Battle Bank? I know Josh just put it up here. It's battlebank.com. And I know that every single time you come on, Rick, you are nice enough to go over a portfolio or a portfolio analysis for people who email you directly.
So, two things, and I have to do this quickly.
Yeah.
The best way to find out more about the way I think is to personalize it. Go to ruleinvestmentmedia.com, list your natural resource stocks, and I'll personally rank them 1 to 10. No charge, no obligation. Rule Investment Media, list your natural resource stocks. No pot stocks, no crypto, no tech stocks.
You can't put in fart coin.
just what I do, right? Just what I do. The second thing is, if for any reason you're uncomfortable with your current bank, which I think means probably all of your listeners, in particular, if you own gold and would like to access credit associated with your gold, check out battlebank.com. Or if you don't want to do that, when you've listed your portfolio at Rule Investment Media, in the question and comment section, simply write in bank. That's battlebank.com. We used to say battle for better banking. Now we say battling to open a bank.
Yeah. I know, inside joke. So Rick, go ahead and take off and I'll go ahead and conclude the live stream. Thanks for your time. And I can't wait to see you soon in Orlando. And I'll tell everyone about you speaking there.
Thank you so much.
All right. Okay, guys. So what Rick was talking about there, as far as that inside joke, was he has been really struggling to open this bank due to all the regulations and the red tape that we were talking about earlier. But fortunately, he has actually been able to buy a bank. And so for those of you who have been hearing about Battle Bank for the last 3 years, they now kind of got around all of those hurdles, and they're going to be opening up to the general public very, very soon. So that's super exciting news. And what's even more exciting is Rick Rule is going to be speaking live at Rebel Capitalist Live He's going to be there. You can see him in face to face. You can meet him in person. You can ask him your questions. He's going to be talking more about gold and uranium and oil and natural gas and the commodities. More about the ability to bank and use your gold to borrow against, and all these really cool things. So if you haven't gotten your tickets to Rebel Capitalist Live, you got to do that ASAP at rebelcapitalistlive.com. As we get closer to the event, the prices go up, so make sure you go there and check that out today. So you have your opportunity to meet Rick and hear him speak, and then also all the other fantastic speakers that we're going to have in Orlando, May 23rd through the 25th. And on that note, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.